We're now crossing live to Abuja, where the Central Bank of Nigeria's Monetary Policy Committee is set for its final meeting of the year, where deliberations on the next policy direction going into 2023 would be made. Let's listen in.
Inflation across several advanced economies is expected to remain elevated in 2022, despite progressive rate hikes by several central banks in these economies. This is predicated on sustained high energy prices associated with the Ukraine war and continued disruptions to the global supply chain. In the emerging market and developing economies, inflation is expected to remain high for other reasons, including the persistence of exchange rate pressures, dwindling capital inflows, and a host of legacy structural issues. In the global financial market, activities in several equity markets have gradually declined as investors take advantage of improved fixed income yields in the advanced economies with the progressive hike of policy rates. Global financial conditions are thus expected to continue to tighten in the near term as risk-averse investors reassign their portfolios. In general, therefore, the global economy and financial markets are confronted with significant risks in the short to medium term as the huge buildup of both private and public debt and the rising risk of debt default are associated with the current trend of rising interest rates, disruptions to the energy market, and poorly functioning supply chains may tip several fragile economies into a new era of recession. Domestic economy. The data from National Bureau of Statistics (NBS) on real gross domestic product (GDP) showed that it grew by 3.54% year-on-year during the second quarter of 2022 and 5.01% in the corresponding period of 2021. The economy has thus sustained positive output growth for 7 consecutive quarters following the exit from recession in 2020. The consistent positive performance recorded was driven largely by the positive growth in the non-oil sector, particularly in the services and agricultural subsectors, complemented by continued policy support by the bank. CBN star projections showed that the economy is expected to remain on a path of sustained positive growth, given the expected strong performance during the fourth quarter of 2022 and steady rebound in economic activities. Members noted with concern the persisting uptick in inflation for the 9th consecutive month, with headline inflation year-on-year rising to 21.09% in October 2022 from 20.77% in September 2022, an increase of 0.32% points. On month-on-month basis, however, headline inflation decelerated to 1.24% in October 2022 from 1.36% in the preceding month, an indication that price development is responding to the bank's recent policy rate hikes. The persisting uptrend in energy prices and the prolonged period of scarcity of PMS petroleum motor spirit contributed to a sharp rise in transportation, logistics, and manufacturing costs, which fed through to consumer prices. Other contributory legacy factors include the lingering insecurity across the country, perennial flooding in major food-producing states, critical deficit of infrastructure in the country, and poor road networks, amongst others. The committee noted that broad money supply M3 grew further by 13.8% in October 2022 year to date, compared with 11% in September 2022. This growth was driven by increased claims on other sectors, in bracket financial corporations, public non-financial corporations, and private sector. In the financial markets, money market rates oscillated below and within the asymmetric corridor of the discount window facilities, in tandem with fluctuating liquidity conditions in the banking system. Consequently, the monthly weighted average open buyback rate increased to 15.91% in October 2022 from 11.49% in September 2022. The capital adequacy ratio (CAR) of the banking system declined in October 2022 to 13.4, but remained within the prudential limits of 10 and 15%. The liquidity ratio at 40.1% was above its prudential limit of 30%. The non-performing loans ratio declined to 4.8% in October 2022 from 4.9% in the previous month, staying below its prudential benchmark of 5%. Monetary policy thus called on the bank to continue to maintain its tight surveillance over the banking system to ensure that non-performing loans ratio remains below the prudential benchmark. MPC noted with concern the continuing bearish performance of the equities market in the review period. The all-share index and market capitalization decreased to 43,839.08 and 23.88 trillion naira in October 31, 2022 from 49,836.51 and 26.88 trillion naira respectively on August 31, 2022. This decrease reflected the sustained sell-off and profit taken by investors rebalancing their portfolios to benefit from higher yields in the fixed income market sector. Other contributory factors include inflationary and exchange rate pressures, tightening external financial conditions, and rising sovereign risk associated with the forthcoming general elections. The committee observed the decline in the external reserves position as gross external reserves decreased by 1.34% at the end of October 2022 to $36.89 billion from $37.39 billion at the end of September 2022. With indications of lower crude oil prices in the future markets, members urged the bank to sustain its current policies to boost non-oil exports in order to shore up the external reserves. Between September and October 2022, under the Anchor Borrowers Program, for instance, the bank disbursed 41 billion naira to several agricultural projects, bringing cumulative disbursements under the program to 1.07 trillion naira to over 44.6 million smallholder farmers cultivating 21 different commodities across the country. The bank also disbursed 0.3 billion naira to finance large-scale agricultural projects under the Commercial Agricultural Credit Scheme. Consequently, the total disbursement under the scheme for agro-production and agro-processing stands at 745.31 billion naira to 680 projects. In addition, the bank released a sum of 48.3 billion naira under the 1 trillion naira real sector facility to 7 new real sector projects in agriculture, manufacturing, and services. Cumulative disbursements under this facility currently stands at 2.15 trillion naira to 437 projects across the country, comprising projects in manufacturing, 240 of them, agriculture, 91, services, 93 projects, and mining sector, 13 projects. Furthermore, under the 100-for-100 policy on production and productivity, the bank disbursed the sum of 20.7 billion naira to 9 projects in healthcare, manufacturing, and services. The cumulative disbursement under the facility therefore amounted to 114 billion naira to 71 projects. Moreover, the bank disbursed 4 billion under the intervention facility for the National Gas Expansion Program to promote the adoption of compressed natural gas for transportation and liquefied petroleum gas for cooking. In support of the resilience of the healthcare sector, the bank also disbursed 5 billion naira to 4 healthcare projects under the Healthcare Sector Intervention Facility, bringing the cumulative disbursement to 135.56 billion naira to 135 projects in pharmaceutical, 33 of them, hospitals, 60 of them, and other services, 42. Under the micro, small, and medium enterprises (MSME) sector, the bank provided support for entrepreneurship development, with the disbursement of 1.3 billion naira and 10 million naira under the Agri Small and Medium Enterprise Investment Scheme (AXMIS) and Micro, Small and Medium Enterprise Development for MSCDF, respectively. Hence, the total disbursement under these interventions amounted to 150.2 billion naira and 96.08 billion naira, respectively. Under the Export Facilitation Initiative, the bank provided support for export-oriented projects to the tune of 5.34 billion naira. Therefore, the cumulative disbursement under this intervention stands at 44.58 billion. Our outlook. The overall medium-term outlook for both the global and domestic economies remain clouded by uncertainties associated with the Russia-Ukraine war, lingering COVID-19 pandemic, and continued lockdown of major industrial cities in China. The persistent tightening of global financial conditions and slowing global trade are also significant pointers to a weakening global economy. On the domestic front, available data on key macroeconomic variables indicate continuing rebound in output growth for the rest of 2022, which may occur at a much slower pace than earlier anticipated in the light of the unfolding domestic and external shocks to the Nigerian economy. The domestic shocks originate from the persisting insecurity, inhibiting economic agents, rising cost of debt and debt servicing, deteriorating fiscal balances, increased spending as the 2023 general elections approach, and a continued uptrend in inflationary pressures. Accordingly, the Nigerian economy is forecast to grow in 2022 by 3.3% CBN estimate, 3.2% the IMF estimate, and 4.2% Federal Government of Nigeria estimate. The committee's consideration. At this meeting, the Monetary Policy Committee was concerned that the global inflationary pressures have continued to trend higher and financial markets were also facing challenges. It observed that this was indeed the trend in Nigeria, with inflation attaining 21.09% in October 2022. The committee, however, seized the opportunity to appraise the efficacy of its decisions at the last meetings and came up with the conclusion that the decisions were beginning to yield the desired results, given that the rate of increase in inflation was beginning to moderate in view of the month-on-month deceleration in prices presented by the NBS, Consumer Price Indices. Members noted that though the global economy was progressively weakening due to the various headwinds derailing the recovery, domestic output growth remained positive as a result of the continued support from fiscal and monetary policy. MPC therefore urged both authorities to continue to harmonize its various policies to achieve the desired objectives of stable price and steady growth. In reaching its decision of whether to loosen, hold, or tighten the stance of policy, committee felt that given that all the causative factors such as Russia-Ukraine war, supply chain disruptions, slowdown in China, and rising inflation in advanced economies and other headwinds were still dominant, a loosening option was not desirable at this meeting. The committee also felt that with the rising inflation, loosening the stance of policy would lead to a more aggressive rise in inflation and erode that gain already achieved through tightening. As regards whether to hold, MPC was of the view that a hold stands at a period close to December festive season and expected heavy spending during the 2023 general election at the time of high inflation would greatly jeopardize the gains of previous policy rate hikes and plunge the economy deeper into the inflation trap. MPC therefore decided to continue to tighten, but at a somewhat moderated rate, noting that tightening the stance of policy would narrow the negative real effective interest rate margin and thus improve market sentiment and further restore investors' confidence. MPC also felt that recent developments in terms of observed month-on-month deceleration in the rate of increase in inflation suggests that the previous tightening moves were yielding the expected outcome. It therefore felt that sustaining the tightening would further consolidate the decline in inflation, albeit more significantly. The decision. MPC noted that inflation has continued an uptrend, even though at a decelerating rate, despite its last 3 consecutive sizable policy rate hikes. The committee's choices were on whether to further hike rates or pause for the impact of the last 3 rate hikes to continue to feed through. At this meeting, therefore, the options considered were primarily to hold or further tighten the policy rate. The options to loosen was not considered, as this will gravely undermine the gains of the last 3 policy rate hikes. Committee thus voted by a unanimous vote to raise the MPR. 9 members voted to raise the MPR by 100 basis points, and 2 members voted to raise the MPR by 50 basis points. In summary, MPC voted to 1. Raise the MPR to 16.5%, 2. Retain the asymmetric corridor of plus 100 and minus 700 basis points around the MPR, 3. Retain the CRR at 32.5%, and 4. Retain the liquidity ratio at 30%. Thank you most sincerely for your attention.
Thank you, Governor. That was the communique number 145 of the 288th meeting of the Monetary Policy Committee of the Central Bank of Nigeria. So yesterday, the 21st, and today, the 22nd of November, 2022. We will take a couple of questions from the press, and of course, tomorrow there's going to be a kind of deep dive on the facts behind the numbers. And so, you tell us your name, the media house you represent, and then your question.
Thank you, sir. My name is James Major with this newspapers. Mr. Governor, like you mentioned, you said inflation continues to be a problem to the economy. Not only here, but even globally. At 21.9% year on year in October, it is really concerning. So what is the way out, sir, of this conundrum? Then my second question, sir, is concerning this flooding, the recent flooding witnessed across the country. What is the impact, likely impact on prices? Thank you very much, sir.
Good afternoon, sir. My name is Leah Katumbawatunde from Nigerian Television Authority. I'm taking my first question from the hike in which some analysts, like the one we listened to just before you came on, saying that it will not bring down inflation. They're doubting that, and you also they sort of feel that it will halt growth. What will be your view on that? And also, since you announced the decision to redesign the Naira bank notes, you've received support from Mr. President. So, however, we're having people talk about the deadline that it might be extended beyond January 2023 to allow citizens, especially those in the diaspora, to make deposits of their own notes. Can you speak to that, as well as the volume of money that has been received so far? Thank you.
Thank you. My name is Sunday Michael Bongo. I write for the Trust newspaper. Mr. Governor, I'm staying with the last question by Leah. At your last special briefing, you hinted that you seem to have noticed counterfeiting with higher denomination. especially the 1,500 Naira note. With the redesigned Naira, are you looking at reducing the volume of the high currency note and encouraging the use of lower denominations? I would like to get an insight into your strategy. Thank you.
Good afternoon, Mr. Governor. I'm Ndukache of the Nation newspaper. Still on the design of the Naira. The CBN recently issued a statement assuring that it will protect the interests of vulnerable Nigerians. Does the suspension of charges on deposits made on commercial banks apply to those through mobile money? Thank you.
Good afternoon, Mr. Governor. I'm Nancy Naji, the anchor of Unveil and CBN. My question is around, I recall that some time ago, you did actually say that the CBN intends to gradually stop the quasi-fiscal commitments made by the banks, made by central bank. Also in media reports, we've seen at least in the last few days that has been reported that the Central Bank of Nigeria wants to stop the anchor borrowers program. So I want to know what the status is on the anchor borrowers program, as well as other related interventions, and also perhaps even the flooding, how it will impact your intervention, since a lot of farmlands were submerged under the flood. Thank you.
Okay, Governor, there are two questions from some journalists from Lagos. This is from Bukola Idowu Leadership. Christian, the CBN website has an exposure draft of the guidelines on contactless payment. Could you take us through that, sir? And then the final one from Babajide Komolafe of the Vanguard. Mr. Governor, congratulations that the National Theatre resuscitation has started yielding results, because we saw that an international conference was hosted 2 weeks ago. When will the entire project be ready? That's all.
Well, let me thank those who are asking questions and those who forwarded questions for us to address. So this is a good opportunity for us to explain certain things that are happening around the way we do our work, particularly in the monetary policy committee decisions. The first question said that inflation is a major headache to central banks around the world, and that for Nigeria, the inflation has hit an all-time high of 21.09%, and that what is the way out of this economic dilemma. You are very correct. To all central banks, inflation is indeed a very, very big headache, and even at this time, it's a big challenge to everybody. This is because everybody knows what impact inflationary pressures can have on the purchasing power of particularly the ordinary people. And these are the people that mainly we have been given the responsibility to make sure that a worsening, inflationary pressure does not totally push them further down into the poverty ladder. However, it is important for us to know that some of the causative factors why the inflationary pressures have persisted since the early part of this year, which includes the Russian-Ukraine war, is not abating yet. The war is still going on very aggressively. US is still raising rates, which therefore will naturally not only lead to outflow of funds to the United States and advanced economies, but will even prevent flows from coming out. Not only that, not just that flows are not coming out, those flows are coming even at very high rates, even within the United States. As a result, financial market conditions globally have tightened, and this is also creating very great challenge for central banks or policymakers, particularly those that may want to access debt to run their operations. And lastly, of course, the issue of the China market slowdown, the China slowdown is also a big issue for the global economy. So I would like to say that these same scenarios still remain in the Nigerian environment, and as a result, we would continue to see the inflationary pressure remaining persistent. However, we feel comforted that the rate of increase in prices, in which case the rate of increase in inflation is moderating gradually in Nigeria. For instance, between June and July, the rate of month-on-month inflation was 1.82%. Between July and August, the rate of month-on-month inflation was 1.7%. Between the month of August and September, the month-on-month rate of inflation was 1.3%. And between September and October, the month-on-month rate of inflation was 1.2%. So for us, we feel that even though the time-tested monetary policy theory expects that at the time when there's inflationary pressures that we would continue to tighten, we'll continue to raise rates, but for us in Nigeria, we feel happy that the decisions that we took in May, in July, in September have started to yield results, because the aggressive nature at which we see the inflationary pressures are abating, and it is in fact declining, and we are hoping that all things being equal, because economists must talk about all things ceteris paribus, that this trend will be sustained, and we begin to see that the inflation rate will come down. So our way up remains that we will continue to see what can be done, but you could see that because we started to see that the rate of increase in prices is moderating gradually, month on month, we were aggressive in September in fact, raising CRR by 5% to 2.5, and also raising NPR by 150 basis points. But at this meeting, we saw majority saying, let us moderate it and do the rate of increase by 100 basis points. Indeed, two members saying that they would have wanted, if they had a chance, they would have wanted the rate of increase in rates to be at 50 basis points. So I would say the monetary policy is looking at it, and I believe that in the course of time, we will see an improvement in the macroeconomic environment. The second question by James Emefiele says that what, in my view, would be the impact of the recent flooding on prices in Nigeria? Like I said, I said ceteris paribus, all things being equal. But what you would expect, that with the flooding the flooding of this year happens to be the worst in the last 5 years in Nigeria. I think I read that out of 36 states, 33 states were impacted adversely by the flood. What that meant was that people who went to farming during the rainy season, they lost their crop. So what you would expect in that direction? You would see that prices of goods will go up, or agri products will go up. But from our side at CBN and the federal government, particularly for rice or for grain such as maize, we know that we have our own strategic reserves, which we will use to moderate prices as they get more aggressive. We've been doing a strategic reserve program for almost 3 years, and it is yielding results, and we believe that will help to moderate. But more importantly, our development finance is holding meetings and discussions with stakeholders that we normally work with for planting, our smallholder farmers and the rest of them. And since the flooding is beginning to recede, we would aggressively go into a dry season planting program that will make sure that the impact of the rising food prices does not linger for too long, so that we can have good control on the price of agri products, which eventually will feed through into the prices of ultimately the goods that our people consume generally. So we're doing everything possible to keep it low, but it is not possible for us to commit that prices will not go up. It will, but we're doing everything possible to keep this at moderated level. The third question says analysts are still doubting whether the consistent rate hikes will bring down inflation. They also feel that raising rates will hurt growth. I will address that. We all know that raising rates will hurt growth, because if you are dealing with reining in inflation, which means tightening and raising rates, that will ultimately, the rising interest rates will hurt manufacturing and agricultural output, that will ultimately hurt the growth. We know that. But at this time, given the aggressive rate at which inflation is trending upwards, monetary policy, seeing inflation or combating inflation as its primary mandate, feel that we must deal with it. Not just that we must deal with it, but also because we believe at 21.09%, inflation is already hurting growth. If we did not see this high level of inflation in the last 7 months, we would have been damn optimistic that growth would have hit close to 4%. But because of the aggressive rate of rise in inflation, it is hurting growth at this level in Nigeria. And that's the reason you would see that we are taking this very, very seriously. Because whether you even try to either loosen or hold rates low, what you will find is that...
And you're still watching Newsday. That was CBN Governor Godwin Emefiele chairing the 288th Monetary Policy Committee meeting today live in Abuja, while also fielding questions from members of the press after reviewing the economic and financial conditions of our economy, while also determining the appropriate stance of the policies adopted in the short and medium term. We actually have a RISE business analyst, Bode Oshosami, joining us now to make sense of the outcome of this CBN MPC meeting. Thank you so much for joining us, Bode, this afternoon. What are your thoughts on the decisions that we just heard and the rationale given?
Well, indeed, it was as expected, 100 basis points from 15.5% to 16.5%. 9 voted for 100 basis points, and only 2 said we should go 50 basis points, which would have been really very dovish. And of course, the reasons included the very tight global financial monetary conditions, even as though we've seen a moderation in month-on-month inflation. Inflation remains a problem, and I think the moderation may have encouraged or given more confidence to have a less aggressive hike from 150 basis points to 100 basis points. Indeed, with Nigeria's inflation still accelerating, albeit at a slower pace, and of course likely to remain elevated because of the floods, the Naira weakness issues, decline in foreign exchange reserves to a 13th month low, 13.89 billion from 37.39 billion. That's another thing that will put pressure to raise rates. All this will probably see the central bank, of course, increasing and hiking for the 4th straight meeting, which is what they did. At the last meeting, the governor already warned that if inflation continues to trend upwards, they would have little choice but to signal that they are really going after inflation by increasing. Although I can see that the growth aspirations mentioned for Nigeria have slightly diminished. Looking at my notes, GDP growth 2022, according to the numbers given to us, CBN numbers 3.3%. IMF numbers 3.3%, federal government numbers 4.2%. The growth for the rest of the year is going to be slightly less than the central bank initially anticipated. And my guess is that the central bank also sees that there's probably need to reduce the pace of hiking or reduce the rate of hiking to address some of these issues in the sense that it's going to have an impact, make the growth situation even worse. But having said that, the global context, Federal Reserve's interest rate path is something that is definitely having an impact, even as we see more capital leaving emerging markets and going to developed markets, and more difficulty in attracting investment from developed economies, given the normalization that is going on. And banks all over the world apparently are thinking of becoming less aggressive in tightening, essentially to support the economies, given that we expect most economies to go into recession next year. And that's going to have an impact on other emerging market economies as well. So I can understand where the central bank is coming from. There are no real surprises here as far as monetary policy is concerned. The rates went up 100 basis points, and of course, we also saw that other monetary parameters were kept constant.
Well, but how do you see businesses responding to this monetary policy decision?
Well, I think that's a very interesting position. My guess, obviously they expected this, so this is what was priced into their decisions. The concern for business now is the macroeconomic stability, exchange rate stability, the interest rate inflation stability, and where these have not been, they are not being addressed. Really raising or reducing the interest rate is not so much the issue. The issue is the inflation rate is still quite high, and its costs push inflation, which means all the factors of their production are going up. So it's becoming more expensive for them to make their products, and all this is eroding profitability. They may expect much more, I guess, from the fiscal side. That is from the fiscal policy, especially to see what they can do in terms of incentivizing better economic activity to create better supply. So supply side reform clearly is going to be needed. But not just that, some of the new excises and taxes that will raise prices or will reduce their profitability is also a source of concern to some. It's probably not the right time to be raising taxes that will be passed on to consumers and will worsen the inflation situation. So I think the issue for business is that the monetary and the fiscal side have to come together and fight this monster of high inflation and mediocre growth.
Well said. Thank you so much for that, Buddy.